Now, without further ado, it is my pleasure to introduce today's first speaker, Dorothy Advincula, Senior Vice President with Ipsos's Media Development Team. Dorothy, you have the floor.
Thanks, Megan. And hello, everybody. If this is your first time joining us for one of these webinars, thank you and welcome. If you've been to some of these before, we thank you for your continued support. And we are excited to be sharing with you our latest outlook on affluent financial investment, which comes from our Ipsos Affluent Intelligence, at the core of which is the Affluent Survey, which is the preeminent authority on affluent consumers, having been online for 43 years. And our data for this comes from our latest barometer, as well as some of our base affluent survey data. And we have had so many experiences in looking at affluent financial outlook. So for this one, we spoke to 1,000 adult households living and earning $125,000 or more, and 200 adults living in households earning less than $125,000. And with this, we kind of understand better their hopes and expectations for the new year in terms of their financial investment as well as their retirement plan. And I will let Tony and Calcaterra to walk us through our agenda, our packed agenda for today on the details and the data that we're going to be sharing with you. Thank you so much.
Well, thank you, Dorothy. It's great to talk to everybody today, and over the course of the next 30 to 45 minutes, we're going to talk about a number of different aspects data from the study. We're going to be looking really at an understanding of the financial outlook of affluence, whether or not that changed or modified during COVID, as well as looking at some differences in gender or differences in generation. And then we'll sum up and give you guys some advice on how to move forward. So, as we look into the relationship that affluents have with their finances, we see this continual need to balance risk and reward. The vast majority of affluents really have what we call sufficient financial insulation that protects them from economic downturns. So that they're often more focused on the need to develop a long-term strategy in their investments, one that will build and maintain wealth rather than reacting to something that is happening at that very moment. So it's not a group of hyper-reactive people. And surely we're going to look and we're going to see different segments of what we call risk tolerance among affluents. But overall, they tend to be more conservative in their approach. And that steady approach really helped them get through the past year. So, few affluents lost ground financially by the end of 2020, despite the economic fallout from COVID. And really, especially considering the steep rise in unemployment, a temporary 11,000-point slide on Wall Street. Half of affluents, despite all of that, told us that their net worth at the end of 2020 was essentially the same as it was in the previous year. And 44% told us that it actually increased. So this is really likely caused by the combination of record-breaking investment levels attained in the market, as well as the fact that many normal affluent activities or expenditures, like expensive vacations, couldn't take place last year due to public health restrictions. So, the reality is that money, because it couldn't be spent, actually helped to bolster the net worth of affluents. In the research that we conducted over the past year, only 1 in 7 affluents felt that if the economy didn't pick up soon, that they would need to either take on more debt or liquidate some savings or investments. So they were well established and in a good financial position to really tackle what was going on as far as COVID was concerned. Now, given that reasonably strong financial performance for 2020, it wasn't surprising for us to see that 2/3 of affluents are expecting that their investments are going to be steady in the coming year. And in addition, we see 1 in 4 that are actually feeling quite bullish about their investment portfolio. Men are more likely than women to feel their investments will go strongly in this year. And also the younger generation is feeling the most optimistic. Many boomers who are nearing retirement or in the early years of retirement, they're the least confident about investment growth, although they're the most likely to feel that their holdings will remain steady within plus or minus 5%. But to put all of that in perspective, there's slightly more concern this year than in years past, particularly to where we were just a year ago before COVID. Back then, there were substantially more affluents who felt that their investments really going to perform well in the coming year, and far fewer of them were expecting to see losses. Fast forward to now, and given the volatility we saw in the market last year, as well as continuing concerns about COVID, its impact on the economy, we still have, or rather we have 1 in 10 affluents who are believing that their investments could decline by more than 5% in the coming year. So there's a little bit of a down note. And that doesn't really surprise us. The increase in pessimism is really consistent with tracking that we've seen related to faith in the strength of the U.S. economy moving forward. So last year we saw an inversion in our optimism-pessimism scale, really for the first time in the past 7 years. And that is really when we were in the thick of things from COVID's impact on the labor market and a slowing down of the economy. We saw pessimism outranking optimism by as much as 18 percentage points mid-year. Now, thankfully, as things got better or as we got more accustomed to what was going on, we saw an improvement in optimism about the economy in the second half of 2020. But currently, 43% of affluents are very or somewhat optimistic about the U.S. economy moving forward, while only 28% are very or somewhat pessimistic. Now, as we've seen in past recessions, like in 2008, 2009, it takes a long time for recovery. And we can't expect these feelings to change overnight. But we do see progress, and we hope that that progress continues. So one of the things that we do is we look back at the beginning of the year, because optimism can often look better at the beginning of the year. And we wanted to just see where we stood this year compared to previous Januaries. And we've been for the last 7 years, looking at a relatively consistent set of questions about optimism. So what we're seeing right now is a lower threshold, and really until restrictions are fully lifted, until herd immunity is achieved, and hopefully the economic engine is fully restarted, we expect to see levels of optimism to be slightly anemic. Gen Z and millennials are currently the least optimistic compared to older generations. But we really should keep in mind that these are the folks that have been hit hardest in terms of job impacts from COVID. We certainly saw statistics that said that the younger people were more likely to have lost a job or to have had economic impact from COVID-related economic fallout. So, in particular, we also have to look back and realize that millennials were hit hard during the 2008, 2009 recession. They were just starting their careers. They were just beginning to build wealth. They were hit hard by the recession. They've now been able to make some progress, but then COVID hit. And again, they took a little bit more of a hit. When we asked how affluents describe their risk approach, what we see are 27% of affluents saying that they take a low risk approach. They're very conservative about their investments. 62% are saying that they take a moderate risk in terms of investing. And a little bit more than 1 in 10 describe their investment strategy as high risk. Those who describe themselves as taking a high risk approach are the most likely to be bullish about the U.S. economy moving forward, which makes sense. Otherwise, they probably wouldn't be willing to take that high risk. And high risk investors are predominantly male. They're a little younger than the rest of the group, and that makes a lot of sense because in essence they can afford to take on greater risk. They have a bigger cushion to fall back on if you look at their median liquid assets as well as their net worth. So if an investment goes bad or goes south, the fact of the matter is that they have the ability to recover without getting hurt too much. As younger investors, they have a longer time frame before retirement, if you think about this, so that a bad investment or slow investment has time to grow and mature. One of the things that we do find interesting is looking at cryptocurrencies. It might seem, somewhat precarious or risky, but what is interesting is that we see relatively decent acceptance by, even those who consider themselves moderate risk. So we're seeing almost as many moderate risk takers owning cryptocurrencies as the high risk takers. And certainly with the way that cryptocurrencies have increased in value, it's an interesting element in the 2021 investment strategy. And you can see also when we look at whether or not these risk investors live for the moment or save for the future, it's not going to shock anybody that the low risk folks are the majority of them are saving for the future, while the high risk folks are about evenly split in terms of saving for the future and being able to live for the moment. Now, given the fact that we're still in the early stages of vaccinations, and remember that this survey was fielded in late January, COVID was cited as the #1 potential impact on affluent finances in 2021. In addition, we have to remember that this was coming 2 weeks after the U.S. Capitol riots and a presidential transition that was about to happen. U.S. government and national politics really looms large as an area of concern that could have substantial impacts on finances. Market volatility, recession, and congressional discord really rounded out the top 5 concerns for the coming year. However, the areas of concern were really different depending on what your risk tolerance was. The more aggressive that you are with your investments, the higher market volatility and recessionary concerns rose in potential or in people feeling that there was a potential for significant impact on their finances. Those on the low risk side were more likely to focus on COVID, politics, and healthcare concerns. But interestingly, most investors felt similar about the big impacts on finances. It's just where they ranked them that differed. Now, compared to pre-COVID, we saw that affluents spent less in 2020 across a number of categories, really except for essentials like groceries. And as we look at these things, we also see that given the need for at-home entertainment, things like streaming video on demand and of course, the pipes, if you will, of getting those services, cable, internet, really saw increased expenditures more than we saw decreased expenditures. So we didn't really see very many cutbacks in those areas. With nowhere to go and little commuting, automotive and transportation costs also saw a huge dip. Almost half of affluents saying that they spent less than they did before COVID on transportation, on automotive and transportation. Apparel, outside entertainment, personal services, such as nail salons, hair appointments, and the like, also saw large numbers of affluents spending less. And, to quote people, if I have no place to go, there's no need for me to look as good. And certainly with things moving to online, to Zoom meetings, there was certainly a difference, and we certainly saw that in terms of expenditures. Really, as we look at this, it's not going to surprise anybody that the hardest hit in all of these areas were dining out and vacations, which literally were off limits. So fast forward to 2021, and when we look at spending levels, they're still predicted to be lower than pre-COVID. However, there's dramatic improvement across a number of categories compared to where the spending was in 2020. We have far fewer affluents who expect their 2021 spending to be below what they typically spent pre-COVID. And now with more freedom to move about, at least anticipated, we're going to continue to see commuting down, but it's better than it's better than it was. And we're going to, really start to see improvement on things like dining out and vacations. We've talked for quite some time about the pent-up demand and, the need for affluents to get out, to sort of get rid of the cabin fever. So we see that this is coming back. But it isn't necessarily coming back to the degree that it was previously. There's a strong chance that that they're going to travel soon, and when they do, they're going to travel in style because, frankly, they haven't spent on vacations for the last year. So there's money and there's a willingness to actually go first class, really have a trip that makes up for the past year. So, in the meantime, because they're not spending at these higher levels and their income really hasn't been negatively impacted, what are affluents doing with the money that they're not spending? Well, with the surplus cash, it's really time for affluents to increase their savings, pay down debt, and prepare for retirement. And in 2021 is going to see a significant number of affluents saving money to various retirement accounts, both pre-tax and after-tax contributions, such as Roth IRAs. Outside of their retirement savings, low-risk investors favor real estate and bonds. And not surprisingly, again, while moderate and high-risk investors will be betting on technology companies to generate additional wealth. Now, many affluents have taken advantage of lower interest rates to refinance mortgages. And frankly, with the inability to freely spend as they have in the past on certain categories like travel, they're likely paying down debt in other areas of their lives. We'll likely see lower spending to continue for part of 2021, at least probably the first half. But flush with cash, then, affluents are really putting money towards planning for a secure future. So we see 16% of affluents are going to be increasing their contributions to company 401ks, and other retirement instruments are also going to see increased contributions. Yes, we're going to see some modification. We're going to see some things like IRAs and other retirements, going down. But for the most part, we're going to see an increase overall. Now, obviously, a lot of thought goes into affluent financial decision making. So what influences them? Where do they get their information? Well, the number one source of information is coming from articles on websites. And that's followed closely by recommendations from friends and family, as well as recommendations from financial advisors. Interestingly, in most instances, when we talk to people about their sources of information, friends and family tends to gravitate towards the top. But this is an unusual situation where the website articles are ahead of recommendations from friends and family. Really, it is it is the nature of what we're talking about in terms of knowledge of a finance market that can have enormous change, and therefore, you need the advice of experts. Now, information sources can vary by generation, although when we look at articles on websites, we tend to think of only the younger generation as heavily reliant on web-based information. But frankly, the use of website articles is consistent across generations, whether you're talking about Gen Z and millennials or whether you're talking about seniors. Roughly 36 to 37% of them are saying that they use website articles in order to get knowledge about financial investments. Now, what we do see, though, is a difference among the generations when we look at the use of recommendations from friends and family. So younger affluents are much more likely than their older counterparts to look to friends and family for guidance and advice. They're hoping to tap into the knowledge and experience of the older generations, really who have already learned quite a bit about the right way to invest and the right way to accumulate wealth. But honestly, the opposite is true when it comes to advice from financial advisors, where the youngest are less likely to be using financial advisor recommendations or to be getting advice from them. Now, what this means for financial advisors is really that they've got to be able to talk to these somewhat new, somewhat naive investors to help them learn how to build their nest egg, and to really get the sense that even though their accumulated wealth so far isn't as great as some of the older generations, that they are still appropriate, or it's still appropriate for them to be consulting with financial advisors, and that they can help them, that they're just as important or can be just as important as some of the older generations. So we all witnessed the dramatic changes that COVID brought to the world. It changed the way we shop, it changed the way we interact with others, and it really changed the way we spent our leisure time. But the question is, did it radically change how affluents look at their finances? In a nutshell, financial planning didn't suffer the same types of cataclysmic changes that almost everything else did during the past year. Most affluents really adopted a steady as you go attitude. They continued to follow their financial plans and their objectives without making major modifications. So like many of the things that we see, that we've seen over the past year, the pandemic really didn't change core values. So, people who were risk takers or people who were curious, that didn't change during COVID. What it may have changed at times was specific behaviors. So the physical things that they did in reaction to something. But they still, if we look at this over the course of the last 4 years, we see very similar levels across things like whether or not people direct their money towards savings or investing, whether they're conservative versus risk takers when it comes to finances. Whether they look at established relationships, so working with a company in the past versus being willing to work with new companies. As well as looking at whether or not they want to work with an established financial company or whether they're open to new and innovative companies. And as you can see, across these 4 years, there's very little change. We would have expected, had the pandemic had a dramatic impact on financial planning, that we would have seen tremendous fluctuation between 2020 and 2021, and quite honestly, we saw none. Robo-advisors. This is always an interesting topic to me because we've been asking this question for quite some time. When we talk to affluents about which they trust more, human judgment or data algorithms, we see that fairly consistently, somewhere between 2/3 and 3/4 of affluents have said that they trust human judgment more than they trust data algorithms. But we still have 1 in 3 affluents in 2021 who were telling us that they trust data algorithms more than they trust human judgment. But interestingly, when we ask them specifically about the name robo-advisor or robo-broker, there's still continued resistance. So, despite the fact that 33% are saying they trust data algorithms more than they trust human judgment, we see only 13% of them who said they're likely to follow a recommendation from a robo-broker or a robo-advisor. So there's this continued resistance to the name. And frankly, if we're going to get greater acceptance or greater use of these things, we've got to come up with a better way to describe them. Now, I always, when I approach these things and look at gender differences, I'm always a little concerned about stereotypes that come out of these things. But one of the great open ends that we got in the survey was from a woman who basically laid this all out. She maintains a very low risk approach to her investments, so putting into things like retirement, while her husband managed a much higher level of risk with his investments, stocks, etc. It works for them, and again, we don't see, she doesn't see it changing year to year, and we certainly didn't see it changing in 2020. So, as we look at this, more than half of men claim to have the final say in household financial decisions. We ask about, which best describes your responsibility. Do you have the final say? Do you have the primary say, or do you share equally? Now, what is interesting is that men are 2.5 times more likely to say that they have the final say compared to women. And women are much more likely to say they share equally. So there's a difference in approach and a difference in how women are looking at the role of making financial decisions within the household. Now, although they lag behind men in terms of making the final decisions or having the final say, we do see that women are becoming more active in household financial decision making than they were a couple of years ago. A lot of this has to do with the change, the changing face of affluence. And we talk about this quite a bit, but as younger generations become, more likely to have, to have a greater proportion of women, a greater proportion of non-white affluence within there, we do see that there's a modification in how they approach decision making. I think we're going to continue to see this as those generations get older, and as the older generations, the boomers and seniors, sort of sunset out of the affluent population. So, this is something to keep an eye on for the future. Now, women are also more likely to say that they rely on financial professionals. So, it's interesting that almost half of the male affluents are telling us that they develop their own investment strategies. While, as we look at the number who get guidance from a financial professional, but ultimately make their own decision, or those that rely heavily on financial professionals, we see more women than men in those categories. And in particular, if you look at this last category all the way on the right, we see that women are much more likely to say that they're relying on recommendations from financial professionals. Now, some of the research that we've done in the past, however, also points to the fact that women tend to be more suspicious or concerned about whether or not financial professionals are treating them with the same level of respect, or have a higher degree of concern about working with a financial professional as to whether or not they're going to be given the right kind of information. So this is an area where clearly women are relying more on financial professionals, but it's up to financial professionals to make sure that in terms of trustworthiness, transparency, that they're doing everything they can to make women feel comfortable. The women also prefer to have a one-stop financial shopping experience. And again, this comes with an understanding and a realization of the level of risk that women are willing to take. So they're looking for what's safe and manageable. And it's one of the things that we need to look at is how women's portfolios differ from men in terms of what they own, where they're putting their finances. So it really is, as we look at this, about the same number of men and women feel that they should be more involved in managing their finances, but they need to find the time. And this is an area where, if you think about the roles that women have, particularly during COVID, where they have had to take on not just their normal roles, their normal working roles, but they've also had to take on a lot more domestic roles, particularly those women with children, with young children that are in school. It makes perfect sense that they're looking for a simpler approach. They're looking for a single company to manage all of their needs because, frankly, they don't have the time. Now, men, on the other hand, are more likely to be looking at wealth transfer plans. So they're more likely to say that they've thought a great deal about how they want their assets distributed when they pass away. They're much more likely to have said that they have written clear instructions about how they want their assets to be distributed, as well as consulted with a finance professional or a legal professional in terms of making sure that they have the best way to distribute their assets when they pass. So we definitely see gender differences in financial approaches. If we look at affluence overall, about 53% of them say that they are savers versus investors, and 71% say they're conservative versus 29% saying they're risk takers. When we look at the gender split, there's a big difference. 65% of women, almost 2/3 of women, are savers, and 35% of them are investors, or can classify themselves that way, whereas men are more likely to say that they're investors versus savers. When we look over on the conservative side, yes, the majority of both genders are conservative versus risk-taking, but you can see the difference here in that men are much more likely to say that they're risk-taking investors versus women. So we also have a difference, really in where people are getting information based on gender. Men, as we saw before, we saw lots of affluence in general, and then by generation using articles on websites. But there's a big difference in the genders. Men are more likely to say that they're using articles on websites. Women are more likely to say that they are relying on recommendations from friends and family. This is an area where I think that we can make progress. You'll see that financial blogs or forums are roughly evenly split. But then when we look at brand and company websites, women rely on that much more. So, as we look to improve information sources or to understand them, we really need to spend time looking at this, not just by gender, but also by gender and generation. As the younger generations become more female, it's going to be important to make sure that the information sources that we're using to get to those younger women affluents are the appropriate ones to make sure that we're able to get information to them in a way that resonates. The generations, I love this quote that, I plan to become an investor. This is from a young woman taking the survey because she's starting to panic about getting old, which at 26 is, I agree with her, it's a little ridiculous, but there's no time like the present. And the important thing is the recognition that they need to start saving and investing at a young age. So this younger generation, when we look at this, they seek simplicity in online tools. They are more likely to say that they prefer one company to manage all their financial services and needs. And if you'll remember from earlier slides, we saw that this was that women were much more likely to say this than men. And this really is indicative of the fact that as you go younger in these generations, you're seeing a higher proportion of women as Gen Z and millennials than we see as seniors. But as we look through this, what we're seeing is this recognition, especially on the part of younger people, that they need to be more involved in managing their finances, but they either don't have the time or they don't have the tools. Now, as we look at things like, okay, well, how do we develop tools to make sure that they work for these younger generations? Clearly, if there's no app, they're not interested. And, therefore, we have to recognize that the tools we produce for them need to be, need to work within the way that they do business. Gen Z are the people to recognize this need more than anybody in terms of I need to be financially engaged. So life stage really relates to the shifts in terms of wealth transfer, and this shouldn't surprise people. Interestingly, the younger generations are more likely to say that they're going to distribute their wealth before they pass away. But as you look at this, the older you get, the more likely that you've thought a great deal about how you want your assets to be distributed and that you've taken actions to do so. So, as we look through this, we recognize that wealth transfer becomes a much more important thing the older you get, and sadly, the closer you are to mortality. So, let's sort of sum up. I've given you quite a bit of information. In reality, the issue is that people want to work with advisors to maintain their wealth and grow their wealth. And that's going to be an important element here. So, if I can give you 4 key takeaways, the first is that, despite what happened last year, most affluents are really holding steady. They've got a true north as far as their investments are concerned. They're going to keep saving, investing similarly to what they've done in the past. 80% of them are saying, look, I make investment choices and I stick with them over time. From a gender perspective, financial companies really need to approach men and women quite differently. Men are certainly more willing to take financial risk, while women are more risk averse. They feel less confident about their own financial planning skills, and they're more likely to consult a professional. But at the same time, as I mentioned, they have big concerns about how they're treated and whether or not they are going to be mistreated, if you will, by a financial advisor, either cheating them or not taking them seriously. In terms of generation, there are clear differences in the goals based on age and life stage. And, certainly the younger generations are looking for more guidance and education. The fact is that we are, a digital society. Digital is going to be important to all of the generations, but frankly, it's going to be incumbent on us to make sure that we have the right information by generation, because not the same information will really be important to every one of them. And then finally, spending is going to return, whether it returns in April or whether it returns in September. The fact is that affluents are going to be back out there spending. It's going to then require that they make decisions about whether they continue these increased contributions to retirement accounts or whether they start spending again in the ways that they did before. So, messages that remind affluents that their short-term and long-term financial goals are still important. And to possibly look at the fact that they got through last year without spending to the degree that they used to, and that perhaps moving forward they can continue to avoid shifts in to avoid shifts and continue to put money into their savings, paying down debt, and increasing their investments. So I hope that this has been helpful to everybody. This is really just the start of data. We have a lot more information that we've collected in this study on attitudes towards retirement, looking at approaches that people are taking, both those preparing for retirement as well as those in retirement. And we will hopefully be able to get that data out to folks pretty soon. So again, let me just thank you for spending time with us today.
Thanks, Tony. That was a great presentation. We do have time for one quick question that popped up.
Okay.
If you'd like to take it, it says, do you see differences by generation in terms of their financial portfolio?
So yes, actually, we do see significant differences based on the generations. Clearly, what we see in the younger generations is less money going towards retirement. They don't see it as looming as much as the older generations do. They're contributing, but they're contributing at much lower levels. But then we see them more focused on investments like technology stocks, which shouldn't surprise anybody, or technology companies' investments, as well as they're the most likely to be looking at things like cryptocurrency. As you get older, as you start to look at the Gen Xers, are clearly focused on preparing for retirement. So we see, a higher level of retirement savings there, which is a good thing. And then, of course, as you hit the boomers, which are really the boomers are sort of straddling between, some of them are close to retirement, some of them are in those early years of retirement. They're really focused on making sure that they have, they're less likely to be putting money towards retirement accounts, but they're more likely to be looking at investments that are solid and steady, things like bonds. They're less likely to be looking at cryptocurrencies, et cetera. And then, of course, the seniors are really looking at, how do I, keep my portfolio generating money? So yes, there's certainly a generational difference.
Got it. Thank you. Well, on that note, I'll wrap up today's session. Thank you so much, Tony and Dorothy, for your super interesting presentation. And thank you for everybody for joining us today. If we didn't get to your question, then we will do so by email. And you will also receive an email with a direct link to today's recorded presentation. Additionally, you can reference the handout section in your event console for more information about the research we shared today. And of course, we welcome the opportunity to speak with you, so please feel free to reach out to us. That now concludes today's webinar. Have a wonderful day, everybody.